Why is shorting the hardest business in the markets? Most people buy stocks hoping that they will go up. That is called going long. That's very obvious. But then there is a small group of traders who do the exactly opposite stuff. They bet on the failure. That is called short selling. You borrow a stock and you sell at today's high price and hope to buy it back when the prices goes down. But here's the secret. Most legends, including Warren Buffett, call this one of the hardest ways to make a living. Shorting is an asymmetrical risk reward. So why is it so hard? It is all about the math. When you buy a stock at say 100, your maximum loss is $100. The stock goes to zero and you're out. But when you short a stock at, for example, 100, your loss is unlimited. There is, no ceiling on how high a stock can go after you place your shorts. If a stock goes to 500 or 1000, you still have to buy it back at the higher price and pay it back to the lender. You can literally go broke being right, or if the timing is not right. If the market stays irrational longer than you can stay solvent, you're gone. Shorting is tough because it requires perfect timing, expensive borrowing, and nerves of steel. It is a bet against the natural long-term growth of any economy. As Buffett says, you can run out of money before the promoter runs out of ideas. This is especially for people who make trend lines on charts and decide to short a stock for a 1:4 risk reward ratio. Before you bet on downside, remember this, that in the game, the odds are just not against you, they are mathematically stacked against you.